bring in some more voices. Sanjay Sinha, founder of Citrus Advisors. Sanjay, the situation seems to be very bleak when you look at some of the headlines, some of the indices, and general sentiment. And it's very clearly the markets have taken a very, very big hit. What would it take for the markets to get back to an even keel? I'm not asking you to give me levels, but what would it take for the markets to actually smile once again, sir?
Mind back and see as to what was keeping the market up all this while. I think one single answer to that is the flush of liquidity that was coming to the markets. For the previous calendar year, this flush of liquidity was coming from the domestic mutual funds, and in the current calendar year, it has been coming incessantly from the FIIs. This single factor has been able to act as a buffer against the lack of earnings growth that the market has seen for the last 4 financial years. Now, post the budget, this single foundation on which the market was standing is now become suspect. And not only has it become suspect, through the month of July, we have seen an extraordinarily high level of selling by the FIIs. Therefore, to answer your question, in the short run, if we want to restore some amount of balance in the market, we need to bring the liquidity flow to the market on an even keel. Given the concerns on the domestic economy and the consequent hesitation from the domestic investors to put in larger sum of money to the Indian markets, I think it is, the immediate task at hand is to get the foreign institutional investors to, if not change their views on India by stopping their by selling, at least to get them to stop selling the way they have been selling. So I think that is one immediate thing that needs to be done, is to restore the liquidity balance in the market.
In fact, let me is about reiterations, but Sanjay Sinha, coming to you, given what the finance ministry has said after that build-up of expectations, and given the reality of the parliamentary system, moving a finance bill amendment in the same session after the finance bill has been approved, I do not recall that ever having happened in the last 20 years. This was, of course, the fastest finance bill passage ever. So I don't know whether there will be a rollback. And therefore, the question that I have for you is now the heavy lifting going to be done by the Reserve Bank of India? Should we all hope from some sort of miracle from the Reserve Bank? And if a significant rate cut were to happen, can that help in the current situation, sir?
So on that, I feel that we have to look at this issue in the short term, medium term, and a little longer term perspective. Most of the action, if they are going to be focused only on the short term recovery of the market, I think that may not be sustainable. The markets at any point of time, market levels, are a function of 3 things: liquidity, valuation, and events. Events are the ones which make an impact on the market in the short term. Liquidity is something that has an impact on the market on the medium term, and it is the valuation which has an impact on the market on the longer term. Today, we are standing at a situation when we have 4 years of lackluster Nifty EPS growth. In the same period, the Nifty has gone up by approximately 65%. So obviously, the Indian markets are trading at very high price earning multiples compared to the growth that they have demonstrated. It is in that context that you will now find that the correction that is happening in the market is also now enveloping those stocks which were trading at fairly high price earning multiples earlier. So the market is now doing a sanity check and questioning whether those high price earning multiples were justified in the first place. Having said that, what is it that the Reserve Bank of India's policy action of reducing rate will do? In my opinion, it is an event that will have an impact on the market only on the short term, and beyond a few days, the impact will peter off. So therefore, I think, given the fact that the government has a fairly ambitious target of raising 1 lakh crore through disinvestment, they need the equity markets to be in fairly vibrant status. Not only that, this year they have also resolved to go overseas with sovereign bonds. Now, the sovereign bonds are going to be raised from people who will also be looking at India on a policy of how does India compare on a relative policy framework, what is the attitude of the government. I heard some of my other panelists speak. I think that, this particular action, the impact of the surcharge on the FPI, I think that may not have been an intentional action. In fact, if you go by some of the statements that the previous finance secretary and now the power secretary has given, he has used the phrase that this was a collateral consequence. I think nobody realized that, inserting that 7% extra surcharge would end up hitting the FPIs very hard. But the government's reaction to that, actually, that is the most unfortunate part, that, they have not come forward to take a corrective action, which was anyway not an intended action in the first place. So I think there is no harm. The parliament is going to be in session till the 7th of August. I think given the fact that, we have lost fairly significant market capitalization and the fact that, the equity markets are now very fragile, there is no harm even now to bring in an amendment and modify this particular aspect of the tax provision. So this will, at least to some extent, address the liquidity concern on the medium term. As far as the long term is concerned, I think, the 3 series of events which have happened over the last few years, starting with demonetization, followed by the implementation of the GST, and last but not the least, the NBFC crisis that have hit the Indian markets. All these things are now coming to bear their full impact on the earnings visibility and the growth momentum in the economy. I think some of the things cannot be reversed, but the NBFC crisis is something that needs to be addressed here and now. Till the time that we get the credit growth back on track, till the time that we get the consumption story back on track, I think the Indian GDP growth story is very much at risk. Given the fact that out of the 3 pillars on which the Indian economy, on which any economy stands, which is consumption, investment, and exports. Exports today are anyway a question mark, given that we have a global slowdown scenario. Investment, as we heard from my friend Nipun, from the private sector, is anyway now suspect, given the fact that the environment is not very supportive. The only thing that we have left is consumption, and I think that was one story that was fairly intact in India. Post the IL&FS crisis, that pillar has also now started shaking. So I guess the NBFC issue needs to be addressed through a front-footed action by collective action from the government, from the Reserve Bank of India, and I think that will be something that will restore the sanctity of valuation in the markets. And therefore, we need to address all these 3 things together. The RBI event could be one, the liquidity could be the second, and the credit, the orderly flow of credit is important to support the valuations of the market. So all 3 need to be addressed.